Silver just broke its own reality. In one trading session, silver didn't rise. It went vertical, calm overnight around $108. Then suddenly, an explosion. Price ripped higher, volume flooded in, and silver printed a session high near $117 an ounce. That's a double-digit move in hours. The biggest single-day surge since 1985. And then, just as fast, it collapsed. Here's the contradiction. The move looked unstoppable, but it couldn't hold. Within hours, silver erased nearly $10 from the highs. If you think this is just traders taking profits, you're missing the signal. Because this kind of price behavior doesn't happen unless something underneath the market is under extreme stress. And this matters to you, not because you trade silver, but because moves like this expose how fragile pricing has become across the entire financial system. When an asset can surge 15% and reverse violently in the same day, that's not confidence. That's instability trying to hide behind momentum. But here's the part nobody is saying out loud. The most important information isn't in the rally, it's in the failure to stay elevated, because that failure tells us what kind of market this really is, and what kind of move is being set up next. What actually happened that day looks simple on the surface, but the structure underneath is anything but. Silver didn't grind higher over weeks, it didn't stair-step, it sat stable, almost boring, holding between roughly $108 and $111. Then the market flipped, volume surged, price accelerated straight up into the 117 range. That kind of move doesn't come from casual buying, it comes from pressure. And importantly, not all of that pressure was directional conviction. Here's the framing most people miss. This wasn't a single event, it was the latest expression of a pattern that's been building for months. 9 consecutive months of gains, repeated upside extensions, and increasingly vertical price action. That's not a normal trend, that's late-stage behavior. Now watch how the story reframes. The rally itself isn't the core issue. The issue is that the market reached a level where participation changed instantly. Buyers hesitated, sellers appeared all at once, and the reversal happened with just as much volume as the run-up. So ask yourself this, if silver demand is truly unstoppable, why did price hit a ceiling so violently the moment it arrived? And more importantly, who needed it to stop there? Because this is where the story stops being about price and starts being about structure. Here's the claim that cuts through the noise. That reversal wasn't emotional, it was mechanical. As silver ripped higher, the market entered extreme overbought territory. On a 4-hour window, momentum readings pushed into the high 80s. That's not a vague signal. That's a condition that historically doesn't persist. When price accelerates faster than the system can absorb it, something has to give. And it did. Look at the detail that matters. As silver surged toward 117, volume didn't fade. It expanded. And when price snapped back toward the 108 range, volume stayed heavy. That tells you this wasn't weak hands panicking, it was a direct confrontation between aggressive buyers and equally aggressive sellers, both operating at scale. Here's why that changes how you read the move. In a healthy breakout, pullbacks are shallow and quiet. This one wasn't. It was loud, fast, and violent, which means large players were active on both sides. Now notice what's missing. There was no gradual distribution, no slow rollover, no time for support to form. Price didn't bend, it broke. And when markets behave like that, it signals exhaustion, not failure. Exhaustion that needs to reset before the next decision can be made. But reset doesn't mean resolution, because the way this reset happens determines whether this was the top or just a pause before something even larger. Now watch how fast this escalates. The problem with a vertical move is that it destroys its own foundation. Silver didn't have time to build support. It erased prior reference points so quickly that when selling began, there was nothing underneath to slow it down. That's why the pullback wasn't orderly. It was abrupt. This kind of behavior isn't new. You see it near major inflection points when an asset accelerates beyond what normal positioning can sustain. Price action stops reflecting gradual belief and starts reflecting forced behavior. Chasing, covering, liquidating, all compressed into hours. What makes this moment different is how normalized this has become. A double-digit intraday surge followed by a near $10 drop would have been unthinkable years ago. Now it happens in a single session and the market shrugs. That normalization is the signal. It tells you leverage is embedded deeper than most people realize. And here's where the story flips. This wasn't silver rejecting demand, it was silver rejecting speed. The market didn't say no to higher prices, it said not like this, which means the question isn't whether silver can go higher, it's whether the system can handle the path it's taking to get there. And that pressure doesn't disappear, it relocates. Here's where the evidence gets harder to ignore. As price spiked, leverage was everywhere. Most of the activity driving that move wasn't physical metal changing hands. It was paper, futures contracts, ETFs, leveraged vehicles designed to magnify upside. And they did exactly that. But leverage cuts both ways. When price stalled near the 117 to 120 zone, those same positions became liabilities. Notice the contradiction. Publicly, the narrative was unstoppable demand. Privately, margin requirements were being raised. That's not a coincidence. When the cost of holding leveraged positions increases, weak capital is forced out. And when that happens during a vertical move, selling accelerates fast. At the same time, short positions didn't disappear. Some traders were still betting aggressively against the rally, sitting on large unrealized losses. When price surged, those shorts were forced buyers. When price reversed, leveraged longs became forced sellers. That collision is what creates chaos. Here's the line that permanently changes how you see this move. The crash wasn't caused by fear, it was caused by structure. A market packed with leverage can't move smoothly. It lurches. And when institutions warn publicly that prices could be cut in half while margins rise behind the scenes, it tells you this isn't just speculation. It's a controlled pressure release. The question is whether that pressure is now gone or just compressed. Now everything starts stacking at once. First, price is still extended far above its long-term averages, even after the drop. That means the reset is incomplete. Second, the move happened after 9 straight months of gains, a statistical stretch where even strong trends tend to pause. Third, the market just proved how fast it can swing when leverage unwinds. That memory doesn't fade quickly. It changes behavior. You can feel the speed shift. Buyers hesitate, sellers don't wait. Every bounce gets tested immediately. Every dip attracts interest, but not conviction. That's what loss of control looks like in real time. And notice the timing. This volatility isn't happening in isolation. It's colliding with rising margin pressure, conflicting forecasts, and growing uncertainty about what comes next. When too many forces hit at once, markets stop trending and start reacting. This is where mistakes multiply. Late buyers chase rebounds. Early sellers regret exits. Everyone watches the same levels, but nobody agrees on direction. So here's the question that matters now. What happens if this continues? If volatility stays elevated? If leverage keeps getting flushed? If confidence never fully returns? Because markets don't stay in this state forever. They either stabilize or they break into something much larger. And the next part of this story determines which one it is. Now bring it back to where this actually hits. If you're watching this market, you're not just watching a chart. You're watching your purchasing power get tested in real time. When silver can swing $10 in a day, that volatility doesn't stay contained. It leaks outward into prices, into confidence, into the quiet assumption that money will behave tomorrow the way it did yesterday. You don't have to own silver for this to matter. You feel it when costs don't settle, when wages lag, when savings stop feeling stable. Moves like this are signals that the system is struggling to price risk cleanly anymore. Here's the part that feels familiar to a lot of people. Every pullback now gets reframed as an opportunity. A drop to $100 isn't seen as danger. It's seen as a gift. That mindset tells you how deeply bullish sentiment is embedded and how exposed late participants really are. But notice the tension. The same people who celebrate dips are also the most vulnerable to sharp reversals. They're reacting, not planning. And that's how volatility spreads from charts into real life. If this feels familiar, say so in the comments, because what's happening here isn't unique to silver. It's a pattern showing up everywhere at once. And that's where the story gets uncomfortable. Here's the part mainstream coverage never slows down enough to explain. This isn't chaos. It's a mechanism. A system built on leverage, incentives, and spectacle eventually forces capital to move faster than fundamentals can justify. When confidence in complex promises fades, money doesn't disappear, it compresses. It looks for assets that can't be diluted, rehypothecated, or endlessly replicated. That's why moves like this keep happening at the bottom of the risk stack. Silver isn't large enough to absorb global liquidity smoothly. It's a narrow opening. When capital tries to squeeze through, prices don't glide. They jump, then recoil, then jump again. The unsettling insight is this: volatility isn't a bug anymore. It's the release valve. It's how the system prevents a full stop. Instead of one clean repricing, you get a series of shocks that exhaust participants and reset positioning piece by piece. And notice who benefits from that structure. Those who can wait, those who aren't forced to act on intraday swings. The system quietly transfers stress from the leverage to the patient. That's why this doesn't end with a single top or bottom. It ends with repricing through instability. And once you see that mechanism, you stop asking whether the move was real. You start asking how much pressure is still trapped inside it. From here, the path splits, but neither option is calm. One path is stabilization, price cools, volatility contracts, silver drifts sideways, or pulls back toward the $100 breakout zone and holds it. That kind of move would reset momentum without destroying structure. It would tell you the market is digesting what just happened, not rejecting it. In that scenario, the recent spike becomes a reference point, not a failure. But there's another path forming at the same time. Volatility stays elevated, every bounce triggers selling, every dip triggers forced buying. Instead of time doing the work, pressure keeps building. And if silver pushes back toward the 120 level without leverage being fully cleared, the next move won't be orderly. It will be faster, more crowded, more fragile. Here's why uncertainty dominates this moment. Both outcomes are plausible, and markets hate that. When participants can't agree on direction, positioning thins out. Liquidity vanishes right when it's needed most. That's how you get air pockets. That's how you get acceleration. And that's how the next decision point forms before anyone feels ready for it. Because the next move isn't waiting for permission. It's already being set up. Here's the takeaway that ties all of this together. What you just watched wasn't a silver story. It was a stress signal, a market revealing how thin the line has become between confidence and instability. The rally showed how much pressure is underneath the system. The reversal showed how little room there is to release it safely. In one sentence, this is the reality. When prices move faster than structure can support, volatility becomes the message. This isn't about calling tops or bottoms. It's about recognizing that the old rules of smooth pricing are breaking down. And once that happens in one corner of the market, it rarely stays contained. Silver didn't fail. It exposed something, and what it exposed is still unresolved. Because the real story isn't what already happened. It's how the system reacts the next time pressure builds, with fewer weak hands, higher stakes, and less margin for error. If you want to stay ahead of that next layer, follow and subscribe. We're going deeper into what this shift means and where the next fracture is most likely to appear.